In this section, we're going to talk about more applications of percents and focus on income tax. Now, I will say that income tax can get quite complicated depending on your job, how many jobs you have, what states you live in, and so on. So we're really just looking for an introduction here to this section. If you have further tax questions, then obviously you should talk to an accountant. Particularly this, when you're doing your taxes at that time of year and things like that. So I just want to preface this with this section is meant to be an overview and kind of give you an idea of how taxes work and how they're taken out of your paycheck. But they do get quite complicated. Even myself, so I am a math person, obviously, but I was also a math major in undergrad and have my master's in mathematics. So I like numbers, I enjoy them. And even for my taxes, I see an accountant at that time of year, just because it gets very complicated the more you have. So when you have houses, or if you have multiple jobs, or if you have deductions that you're trying to take for work and so on, it can get quite complicated. So I'm just going to preface this section that we're going to do an overview here and an introduction. But if you do have further questions, you can let me know and I can try to point you in the right direction. Or of course, you can talk to your accountant if you're looking for some personal answers for taxes. So first of all, what is an income tax? So an income tax is a percentage of your income that's collected by the government to fund its services and programs. So part of what you make, so when you get paid, some of your paycheck gets taken out for taxes. And there's different kinds of taxes. So they get taken out and they go to help pay for things like schools and police and firefighters and road repair and so on. So they go towards a lot of wonderful things. Even though we don't like losing our money, they do come back to us in other ways. So the federal government collects income tax, and most but not all state governments do as well. So states such as Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming, at least as of the printing of your checks, have no state income tax. Massachusetts has a state income tax, so those of you from here, New Hampshire, our local states do have state income taxes. So tax revenue pays for our national defense, it pays for fire, it pays for police stations, road construction, schools, libraries, parks, etc. It pays for a lot. Without taxes, the government would not be able to conduct things like medical research, provide medical care for the elderly, or even things like send astronauts to space. Income tax is automatically withheld from your paycheck by your employer. So when you get a new position, they have you fill out many, many forms. And one of those forms is a W-4. And when you fill out your W-4, you give some basic information so that they know about how much to take out for taxes out of your paycheck. Now, if you're in Massachusetts, again, there's other forms to fill out as well, because we do have Massachusetts state tax. So I'm not going to focus on state tax in this section. We'll just talk about federal. But do know that you may have other forms to fill out in addition. But that W-4 basically says how much you should have taken out of your paycheck each week. Now, the IRS, which is called the Internal Revenue System, collects the taxes, and it's a branch of the Treasury Department. Now, one thing to note, so when you get your paycheck, right, they take out taxes out of your paycheck whenever you get paid. And that's an estimation of what they think you're going to owe for the year. When we do our taxes, so we say we do our taxes in April, right? They're usually due by April 15th. That is each person's opportunity or to make sure that they've paid the right amount of taxes. So what happens is at that point of year, we sort of reassess our income for the previous year. So we do it in, February, March, April for the year before. We look at our entire income for the year, what we actually earned, right? And we'll talk about what income is as well. And then they look at all that. They look at things like deductions that you can have counted so that your taxable income becomes lower. And they figure out how much tax you should have paid in the previous year. So if you paid too much, that's when you get a refund. And if you didn't pay enough, that's when you owe more money. So when we have the amount taken out of our paycheck, let's say on a weekly or bi-weekly basis, we're estimating there. We're estimating what we think we're going to owe for taxes. Ideally, April 15th, you would have a thing that says 0, meaning that you paid the perfect amount of taxes for the entire year and you're all set. But it doesn't usually work that way, right? Because we're estimating how much we should pay each week. So typically, once you file your taxes in April, you'll either get a refund, which means that you had too much money taken out of your paycheck, on a weekly or biweekly basis. Or if you owe money, it means you did not have enough taken out of your paycheck on that weekly or biweekly basis. So if you're in that second category, then you may want to go back to your employer and redo your W-4 form and make sure you filled it out correctly the first time, so that you're having enough taxes taken out. I know for me, it's always really sad if I have to owe money in April, especially when I'm not expecting it. So you can always go back and redo your W-4 and have more money taken out of your paycheck if you find that you're consistently owing money when you do your taxes in April. All right. So the section is a lot of definitions first, and these are taken from your textbook. So your textbook actually has more examples and more detail you can read there. I tried to pick out the key pieces. So first of all, how do we determine our taxable income? Federal, and I'm going to talk about federal taxes. So federal income taxes are a percentage of your taxable income, which is based on your earnings in a calendar year. So we do January through December. And as I mentioned, when the year is over, you have until April 15th to file your tax return. And that basically says, did you pay the right amount of taxes in the past year? Your gross income is the total income for the year. So let's say you got a job, and you just have one job. You have a pretty simple kind of schedule here. You're not getting tips or investments and things like that. And let's say you make $50,000 a year. That was your salary. That's your gross income. Okay, so your gross income is whatever you've made for the year, not including taxes and things. So it's just the flat salary. So it's typically your income from wages. It could also be money from tips. So if you're in a tip field, like if you're a waitress or a bartender, interest or dividends from investments. So I have to say from, not form. Unemployment compensation. So if you received unemployment, you do have to pay taxes. Profits from a business, rental income, or even game show winnings. So same thing, if you win the lottery, particularly if you win a large amount, right, you definitely have to file that as part of your income. So there are levels here for game show winnings and lottery winnings and things like that when you actually have to start reporting that as well. And these can be even in the form of prizes. So even if you won a prize, like let's say you were on a game show and you won a car, that's still income. So the value of that car would affect your income when you do your taxes. A lot of times when you do win, like if you win on the lottery and you win a large amount, they will take taxes out right then as well. A lot of times you can have it taken out then so that you don't have to worry about this back in April. But you still have to report it as winnings. Your adjusted gross income is figured by taking your gross income and subtracting certain allowable amounts. These are called adjustments, and they're very specific. So things that are adjustments are typically, let's see, your certain contributions to retirement accounts. So we have certain retirement plans, those that are typically done through your employer, or IRA plans that you can put money in without paying taxes. What happens is you pay taxes later when you take the money out. There are also tax deferred savings plans. So a lot of like college education plans, if you set up for your children, are tax deferred. So they do have some tax deferred savings plans where you can put money right into that account without paying taxes on that income first. So you usually do it right through your employer. Interest paid on student loans. So those of you who have student loans, if you're paying interest, you want to be reporting that when you do your taxes in April, and things like alimony payments as well. So again, these are very specific adjustments that we take away from your gross income to lower your taxable amount. Okay, so that's called your adjusted gross income. Sometimes you'll see this as AGI. All right. Now, in addition to those adjustments, we are also entitled to certain exemptions and deductions as well. And this is sort of, when you're thinking about doing your taxes in April, these are the things that you're thinking about now. They do change sometimes from year to year, so you do want to be careful. Again, I'm going to mention some here, but it really depends on year to year what is being allowed that year. So the IRS website will often have information, or even your accountant can tell you, yes, that's being allowed this year. No, it's not being allowed this year as a deduction. And it can change. So an exemption is a fixed amount on your return for each person supported by your income. And you're entitled to this fixed amount for yourself and each dependent. So if you are the head of your household, for instance, and you're supporting, let's say, young children, then those would be your dependents. So you are allowed certain exemptions for that amount. And these are determined by the government. So they'll say, you know, for this year, an exemption is $2,000 per child or something like that. A standard deduction is a lump sum amount that you can subtract from your adjusted gross income. And again, the IRS sets up this amount. So when we talk about deductions, and this can get really confusing, you're either going to be in one of two categories. So you're either going to take a standard deduction, which the IRS will determine the amount. So they may say that, you know, the standard deduction is $5,000 this year. I'm just making it easy. So you will say like, okay, I'm going to do the standard deduction. A lot of young people do this, or people who don't own a lot of property and things like that do the standard deduction. You can also do what are called itemized deductions instead. So these are deductions that you list separately. And again, the government determines what they consider appropriate deductions. So things that are usually accepted are things like interest on home mortgages, state income taxes, property taxes, charitable contributions. So if you're donating money to charity or giving items to charity, and medical expenses exceeding, so over 7.5% of your adjusted gross income. And there are others too. So again, these can vary from year to year, what they decide to accept and what they decide not to accept. As a personal example, I know myself, my husband's in construction, and for a long time, he was able to use some of his expenses for work, things like uniforms, for instance, or certain tools he needed to purchase for work as deductions, certain mileage for deductions. So just driving to and from work from your home is not considered mileage that you can deduct. But if you go from job site to job site, the mileage in between used to be allowed as part of the deduction. And then in recent years, they changed that and they said, no, we're not allowing this deduction anymore. So that's what I'm saying. Sometimes it changes from year to year. So your accountant would know exactly what you can and cannot deduct. So that's where it gets tricky. So if you have a pretty simple lifestyle, right? So if you just have maybe one job, you don't own any property, you don't have a lot of, you know, mortgage payments and or charitable contributions and medical expenses, then you're going to probably just take the standard deduction. So you're not going to go through and itemize everything. I know that's what I did before I got married. And before we owned a house, we just did the standard deductions because we didn't have a lot of stuff that would qualify according to the IRS as deductions. As I've gotten older, I have more deductions now. So we do own our home. We still have a mortgage on it. So we have interest for our mortgage and things like that. So each year we have to look at it and break down, okay, should we take the standard deduction or do I have enough itemized deductions? And it can change year to year depending on what's allowed. So again, it gets pretty tricky, and you should talk to your accountant or whoever's helping you with your taxes about your own specific situation. So as a taxpayer, you should choose the greater, either the standard deduction or itemized deduction. So you add all your itemized deductions together. If that's more than the standard deduction, then you would do that. If it's not more, then you would do the standard deduction. And then your taxable income is figured by subtracting exemptions and deductions from the adjusted gross income. So your taxable income is not always your full gross salary, because we do allow for these adjustments, deductions, and exemptions that reduce what is called your taxable income. So how much you actually pay taxes on for the federal government for certain things, right? All right, so let's do an example. Hopefully this will make a little bit more sense. It says a single man. Now, when I say single, I do have to, the IRS does actually look at if you're single or married and how you file. So we can say you're single, so you file by yourself as an individual person. It doesn't mean you're not dating somebody. It means that legally you're filing as a single person. They have married designation. They also have married filing separately versus married filing jointly. So if you file separately and you're married, it means the two of you are each filing your own separate tax returns. If you are filing jointly, you do it together. So you're putting both your income on one tax return. So again, these designations of single and married are really at a government level to determine how they should do your taxes. So this man is single and he has wages of $46,500. And he also received $1,850 in interest from a savings account. He also received $15,000 in winnings on a TV game show, lucky him, and he contributed $2,300 to a tax-deferred savings plan. He is entitled to a personal exemption of $4,050 and a standard deduction of $6,300. He paid $2,100 in property taxes, $1,855 in state taxes, and he contributed $3,000 to charity. All right, so this is all his main information. And again, this is actually pretty simple. So it can get quite complicated, which again, if you're starting to get too complicated, then you may want to reach out to some sort of professional. So the first thing we're going to do is figure out his gross income. Okay. So his gross income is everything that he has made. Here's my example. There we go. So his total that he's made for the year, it's his total income. Now that's going to include his salary, right? His wages. So 46,500. It also includes interest though. So interest is money. It could go either way, but if you have a savings account, it's money that the bank is paying you for keeping your account with them. So this is an earnings. This is a lot too. So he must have a lot of money in a savings account if he's earning this much money. Most people probably earn something negligible, a few dollars, $30, $100, something like that. And then he also won $15,000 on a TV show. So his income is not just the 46,000, it also includes interest he received, it includes his winnings that he received, etc. So he has altogether $63,350 in his income for the year. So now we're going to find the adjusted gross income. And again, sometimes you see the abbreviated AGI, so if you see that. So we're going to take his total income and we're going to subtract any of these adjustments. Now, our adjustments are very specific, right? So we talked about them on the page before. So if you need to go back to your notes, you can go ahead and go back to your notes. So your specific adjustments tend to be payments to retirement accounts, tax deferred savings plan, interest on student loans, and alimony payments. So here I do see that he contributed $2,300 to a tax deferred savings plan. That is an adjustment. So I'm going to subtract out that $2,300. And I get $61,050. Now his taxable income, so we're going one more layer here, is his adjusted gross income minus exemptions, exemptions, and extra deductions. Okay, so you typically find that you can take a personal exemption when you do your taxes and potentially exemptions for dependents. Again, it sort of gets tricky there in your household, who's head of household, who's not, particularly if you have more than one income. So when concerned, talk to your professional accountant here. We're just trying to give you in this class an overview of how things work, right? So I'm just kind of giving some general examples. And then you also have those deductions. So remember, for your deduction, you're either going to choose the standard deduction, or you're going to do your itemized deductions. You cannot do both, right? You do one or the other. So whatever one is larger, you're going to take that one to reduce your taxable income. All right, so for this person here, we have $61,050 for his adjusted gross income. And let's read through again and see what we have. All right, so he has his personal exemption. So his personal exemption is going to be for $4,050. And again, this is determined by the government. And then we have our deductions. So now we need to make a choice. So the standard deduction here is $6,300. And for itemized deductions, he has the following. So he has $2,100 in property tax, $1,855 in state taxes, and $3,000 for charity, right? So let's look at all of this together. Did I miss anything else here? think that's it, right? Okay, so I'm gonna take that 2,100. I'm gonna take that 3,000. I'm gonna take that 1,855 here. All right, so let's add these all up. Let's see, I get 5, 5, 8, 9, get 5, and I get 6. So my total itemized deductions end up being 69.55. Now, because this is bigger than the standard deduction, we're going to take the itemized deduction here instead. So we're going to add in that 6,955. All right. So I have 61,050, and I'm going to subtract out. Let me just add this up. Let's see, 11,005. And when I go ahead and subtract that, I have $50,045. So finally, that is his taxable income. So that's what he's going to pay taxes on for federal income taxes. Okay. Now, this example here is similar to what I did in the book. I did leave off the mortgage interest just as I was typing, but it's the same process here. So you would do that same check. You're following along the text. You're looking at your standard deduction. You're comparing it to your itemized deduction. Whichever one is biggest, that's the one you add in. You can't add in both. So be careful as you're reading through these problems because they can get a little tricky.